Today, folks, I gotta share with you my 3 favorite dividend stocks in Canada right now that could very potentially make their way into my portfolio this year. But we're gonna broad view the whole economy, look at where the discounts truly trade, from energy to financials to even the distressed real estate sector, just to see what the economy looks like heading into 2025, along with my personal plans. So if you're on a path to financial independence, if you damn well one day want to retire early, join me by hitting that subscribe button, because firstly, my goals with my specific portfolio, excluding what my wife is doing, has always been to basically scale this to about a $500,000 portfolio, with about 200,000 invested in the S&P 500, about 100,000 within SCHD, that US Dividend ETF. I want to get about another 100,000 in VDY, and then about 100,000 spread between individual positions that are relatively concentrated. So they're like sizable, impacting positions, because they're too small. They, typically won't make enough of an impact to be worth investing in. So it's kind of playing this strategy of getting a nice, healthy, slightly higher yield than the average market is giving me, but also trying to edge out some higher returns from some of these individual stocks. Currently, the portfolio is sitting around 347,000. Actually, we're likely much higher than that because the market is propelling today, but my spreadsheet only updates about once a day, this iCloud numbers for you. But if you guys enjoy the way this spreadsheet looks, you want to get a little insight into how the wife and I invest together, go to kylelivingston.com. Link is in the description below, where I do offer these as products. However, I really want to take a listen to a broad view of the Canadian economy from this recent BNN video that I saw, and then we're going to break down the different sectors of the market, followed by my 3 favorite Canadian dividend picks for this year.
All right, Gavin, back to Canada, where you see better value. You like certain sectors, and some of the names you're mentioning here in financials: RBC and Manulife, Capital Power, Enbridge, REITs. Can you elaborate on your concept here that Canada is a better place to be?
Yeah, for a start, even though it did pretty well last year without having any of the Bank 7 stocks, I think the TSX 60 was up 18% against 25 for the S&P 500. It's got a big exposure to financials and interest rate sensitives. And obviously, with rates coming down, we're down remarkably enough, 1.75% in Canada. Canada's been the market leader in cutting interest rates, perhaps because the Bank of Canada is distinctly worried about the slowing Canadian economy and the effect of high interest rates have been having on the consumer. And as a result, the interest rate sensitive sectors, which is pipelines, utilities, financials, REITs, telecoms, actually are starting to do better, although with the continued increase in 10-year government bond yields. Ironically, the Fed cut rates 100 basis points in the last few months. Longer-term bond yields in the US are up 100 basis points, which might reflect the fact that there's going to be a very, very large amount of US government bond issuance. But either way, the financial sectors have started to do better. The pipelines, the utilities, the financials. In fact, some of the strongest performing stocks have been things like World Bank, National Bank, Manulife, and the same thing in the States. And realistically, there's going to be further interest rate cuts. So these interest rate sensitive sectors look good. One interesting area, you touched briefly on the REITs. Both retail-centered REITs and apartment REITs have actually been lagging somewhat, even though interest rates have been coming down. We all know the difficulty of getting rental apartments in Canada, and retail, especially grocery-based retail, has proved to be extremely resilient. So those sectors of the REIT market look really interesting.
So I want to break this down into a few parts, because Canada's been very aggressive on the interest rate cuts, which I think helped, some of these ETFs that we're going to talk about, like VDY, even the broader-based VCE that represents, the S&P 500's version in Canada here, have really performed exceptionally well, like almost in line with the S&P if you include the dividends, largely because we've been more aggressive on cutting rates, but that has led to a much weaker dollar. But I want to talk about the sectors he mentioned, because I think it's crucial going into 2025 to see what analysts think, where we're going from REITs to utilities and so much more in between here. But my VDY, again, till I motherfucking die, is where I'm still going to keep loading in 2025. It's going to be a lot of my attention. It did start to underperform VCE, but that's because I think VCE has concentrations in tech companies like Shopify that have really propelled, Constellation Software, and companies that I'm not really that big of a fan of, to be honest, unless, again, they take those massive, crazy dips, because they tend to trade at much higher multiples than I'm comfortable with. And I primarily particularly look to Canada for dividend income, as many of you probably do. So VDY, I still think, is one of my best investments, hands down. It's got that great exposure to upper weighting the banks like Royal Bank, Toronto Dominion. Enbridge has been on an absolute tear over the last year. We'll talk about that along with some of these other companies here. So firstly, let's just kind of take a look at the REIT sector. I believe REITs are trading at some of the most value we've seen in their entire history. I don't think a lot of people are arguing that, but most people don't have the stomach or the long-term, stamina to actually ride through this volatility when you're looking at tech companies and the things the market is chasing going absolutely parabolic. Because over the last year, we've seen about 6% from a capital gain perspective out of this broader REIT ETF. And if we zoom out on the max, we'll see that, nothing has really happened here in quite a period of time. But keep in mind that does not mean there isn't a lot of discounted opportunity here. Then you got the equal weight bank ETF here, like ZEB. I told you guys, like Pokemon cards, you want to be collecting them all. This is another reason I like VDY so much. But the banking sector really is starting to have a wicked comeback here, really starting to push back toward those all-time highs as the sector as a whole represented in this ETF. And if you want sector exposure, I really think you can't go wrong with like the HBNK. That ticker for that ETF is probably better than ZEB because it comes with a lower expense ratio. But again, financials have crushed it. So let's take a moment and pick apart the largest holdings within these ETFs to get an idea of how they're performing. And then we're going to take a look at my top 3 picks. But we'll kick it off first and foremost with the most intriguing sector in Canada right now, which is the real estate sector. Because unlike the US, we've been cutting interest rates much more aggressively. So the bullish sentiment around this sector is growing pretty dramatically. And we're talking about, first and foremost, Canadian Apartment Properties. This is Canada's largest pure play residential REIT that over the last 5 years has lost 16% in capital value, with currently a 3.5% yield, which I promise you is historically high for this REIT. And keep in mind the market cap, I'm going to come back to this in a moment, at $7.3 billion. As we break down the financials, I just want to look at cash flow. We're just going to take a look at revenues. You want to go look at funds from operation and really break this down more in depthly. I wouldn't use this as financial advice, but still, I think you're going to be pretty astonished to see that revenue went from $268 million to $282 million. The company was actually able to grow its revenue. Let's take a look at its cash flow, right? The company has actually been able to grow its cash flow from $236 million to $308 million. Looks pretty promising, right? Against a balance sheet where they have almost $17 billion in assets and about $7.6 billion in liabilities. So somewhere around $9.5 billion in underlying asset value. Doesn't make a whole lot of sense when the stock's only trading for $7.3 billion. So it's trading below its underlying assets, which, unlike physical real estate, REITs can actually disconnect from the underlying asset value based on perception, right? And unfortunately, money follows momentum. So if the stocks are skyrocketing, like your Teslas, your Palantirs, your Nvidias, that's where money's going to chase. Whereas if the stocks are getting suppressed, people will shit on it, tell you it's a horrible investment, and the stock will likely continue to underperform. So if we take a look at what analysts expect here, there's no surprise. Analysts are very bullish in this sector with the aggressive interest rate cuts going on and the expectations for 2025. We're talking about the lowest analyst expectation of $49, a high of $60, and we're trading currently at $43. So let's look at the largest mall REITs. Hashtag my Riocan out there. If you went to any malls over the holidays, I guess malls aren't dead. They were packed to the nines. It was absolutely crazy. It's like every day was Boxing Day. I don't know who the heck leaves their Christmas shopping to the last minute. But again, this is a company with 6% yield, $5.5 billion market cap. We zoom out, it's offered a 29% negative return from the capital growth standpoint. But let's take a look at the actual financials as well. If we dig around a little bit here, we take a look at the quarterly, we can see the company went from $271 million to $286 million with some ebb and flow. We hit a high of $303 million. So the cash flows, or the revenues for the most part, seem fairly strong. If we take a look at the cash flow itself, it's been a little bit more dodgy. And again, you want to go look at the funds from operation. You can't really use these metrics with REITs as similar as you can with basic, companies like Meta, for example. But assets, $14 billion versus $7 billion in liabilities. Again, we're talking about a company trading for $5 billion. It trades for a very similar disconnect that Canadian Apartment Properties does, and the analysts seem to follow the same rhetoric. We're talking about a lot of strong buys. $20.50 at a low analyst to $23 at the high price targets, and currently we're at $18.58. So all of these look like they're screaming buys, right? And the most disconnected and the most intriguing are things like Allied. Allied has offered the worst returns for an office-focused REIT, down 65%, $2 billion market cap, and a 10% dividend yield. Financially, if we take a look, this is a company that has been generating on a quarterly basis here about 146 million, that has actually been up above this time last year, but again, fairly volatile to some extent because they hit a high of 150 and dropped slightly, but still very strong revenues. Let's take a look at the cash flow. Cash flow, again, actually surprisingly strong. It is kind of ticking to the downside, but still fairly strong. And the underlying assets, 10 billion versus 4 billion in liabilities. So what is that? Like 6 billion roughly, give or take, in underlying assets against a $2 billion market cap. So a lot of people, again, are seeing these as buys, and it's no surprise at the beginning of the year, they are actually performing exceptionally well against the broader markets, right? So that's the real estate sector. Let's talk about the financials. And like Pokemon cards, I'd rather just own them all. And I told you the opportunities have pretty much passed us at this point. All you can really do is cost average. You missed the real dip buys with something like Royal Bank that is now up dramatically, 67% with their recent purchase of HSBC. The Canadian counterpart of that bank has really propelled their revenues, and it's going to continue to propel them over last year when they actually had that acquisition close. So we should still see some pretty strong performance overall, though. The amazing dividend yield gone. Let's just take a look at the analyst price targets here to see what they're thinking. Yeah, we're kind of right in line with the analyst expectations. So this is a continued, in my opinion, to be a buying stock. It's just not a discounted stock anymore. So, that's what really you have to consider when you're looking at the individual banks. The biggest bank, the biggest company in Canada, isn't a buy anymore as much as perhaps TD is, if you can get through some of that volatility, right? TD got hit really hard. Some of those other banks still open up some opportunities, but again, if you cost average between them all, you get the average performance, which statistically tends to be stronger than the broader Canadian market. So the banks have been very resilient here in Canada for those reasons. But Enbridge, I want to talk about this. It's the third largest company in Canada. It's, again, I own pretty big exposure to it through VDY. It's 8% exposure through this ETF. And Enbridge, I've heard so much negativity about this company since I've been investing, my investing career over the last decade. And they always say, can't afford the dividend, guys. It's a horrible company. It's a limit growth, blah, 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 blah. Meanwhile, they purchased a massive natural gas utility in the U.S., which has made them one of the largest powerhouse natural gas companies in North America. They are the largest pipeline company in North America. They are the blood flow of energy for North America. They're not going anywhere, folks, and they're highly interest rate sensitive, which we'll see. With currently a 6% yield, 5 years is returning 21%, recently just took off, $136 billion market cap. If we break down the financials here, we're talking about a company over the quarterly from this time last year that went from 9.8 billion to 14 billion. So it's not a growing company at all. No, this growing company says who, right? They don't know what they're doing. Gross profit still pretty strong here. Cash flow, how's that looking? Again, very strong cash flow as the recent couple quarters, almost bringing in $9 billion. Balance sheet wise, this is where we get to see the debt. This is what's killing them. The $115 billion against $180 billion in assets. So as interest rates come down, these companies are going to continue to do exceptionally well. And I don't know how you cannot be bullish. Yeah, it's going to have some sensitivity to oil, but it's largely diversified in many other sectors. So let's just take a look at what analysts think, because I'm bullish on this. And sure enough, their analysts are generally kind of mixed. It's kind of like Royal Bank. They think it's fairly valued here, sitting almost exactly at analyst price targets. So I like this company still. I like getting the exposure through VDY and cost averaging into it. And we'll see what it kind of brings into the future here. But as interest rate cuts come into play, I don't know how people aren't more bullish. I mean, cash flow should materially start to increase here very shortly in the coming quarters, especially as they continue to cut. From a dividend standpoint, the dividend historically is still high compared to its averages here, and they recently look like they bumped the dividend quite nicely. So great dividend growth from 2018 here, going from $1.30-ish to where we sit today at $2.86. Growth beast for dividends. What a great company overall, though, man. The performance has been wild. So let's talk about my three favorite Canadian stocks that if I were to buy individual Canadian stocks today, this is where my focus is and will likely continue to be. If I get the opportunity to pick them up this year, I might. But we're talking about Canadian National Railway. This is a company that has seen nominal growth, 24% over the last 5 years, really kind of underpacing the market, a 2.3% dividend yield, which if we just take a look at that yield is historically the highest it's been pretty much throughout the entire history of this company. And like I told you guys, you can use yield the percentage of that yield to the value of the company, because statistically AAA rated companies like banks, when those yields spike up like that, they're always really great buying opportunities, and they have proven that historically over 70, 100 plus years. Some of these companies have been around for, right? And here we are with the historically highest yield this company's ever paid, and incredible dividend growth over 5 years from 2019. What was it, about $1.40, $1.30 to where we sit today at $2.60, doubling the dividend in 5 years. I mean, can you really complain, right? From a financial standpoint, the growth has sputtered a little bit, but we can see going from 3.98 billion to 4.1 billion isn't excessive growth. But it's still very healthy growth, right? How's the balance sheet look? This is fairly debted company, but a very stable company, very similar to Enbridge. If we actually take a look at the revenue and profit and take a look at the shares, it's a company that has very aggressively bought shares back, unlike Enbridge that's diluted to offer, equity growth by, acquisition. This company is just very steadily buying shares back and more aggressively as of recent. So you can get very steady returns, and the company I think is trading at a discount today, so there could be some short-term pops and long-term incredible stabilized growth. My goal with stocks, as I told you guys, the things you can really look for if you want great companies, stabilized returns, you want low volatility, you want a company that can do share buybacks and increase the dividend. It's not like I'm asking for the world here. A lot of companies are able to do this, and Canadian National Railway is definitely one of them, along with Hydro One, for example. Hydro One, I don't really think should fit in the discounted pile, but I really like low volatile stocks because, again, as my portfolio scales, I wouldn't enjoy taking like all of our money or like the 300K I have invested and just throwing it in a growth stock, right? Like I'm at the point, I'm only 32 years old, guys. I could just turn this portfolio off for 30 years and I will be worth millions. I mean, like it's crazy at the value that my portfolio can have if I'm just really cautious and very thoughtful and methodical about how I invest. But Hydro One, a government spinoff that focuses in Ontario, one of the fastest growing economies when it comes to like just people moving in and building houses. And this is not a hydro producing company. It produces a bit of hydro, but it's mostly a transmission line company. So whether you believe in solar panels or power walls, it doesn't matter. A lot of it has to go through the hydro lines, at which is government regulated, and it pays currently a 2.8% yield. If it dips enough, you get closer to 3%. It's a really good buy, and I do like this utility above pretty much all the other utilities just for the stability that it offers. Leading us into the third stock, and then I'm going to give you a little juicy benefit stock that I still think is a great buy, though is very argued across the Canadian investing landscape. But I love, first and foremost, Waste Connections. This one I am very highly considering buying. They're kind of projecting out high single-digit growth, but this year they were able to do double digits, and something tells me because of the acquisitions they made and the growth this company's had over the last 5 years that they can still continue to do so. I know the dividend yield is not that high and it's not that exciting for most people. Historically, the dividend yield doesn't really inch much past 0.7 with the with the exception of where the stock was coming out of 2008. But this company, again, you go back to 2019, 5 years ago, from 60 cents to $1.20. They doubled the dividend in 5 years, and you've gotten great capital returns. And the reason I like this stock so much is because I believe they have a lot of future potential in plastic recycling, which is why I talk about DuraClean Technologies so much. And I think it's just a great sector to get low volatility, great returns that have actually kept up and outpaced market performance. But finally, the last stock that I don't know if I'm going to buy this. I keep debating on buying it. I'm looking at it, and I really just want to start seeing a recovery. And I feel like I might miss the initial bump, but how do you not look at the telecoms as monopolistic companies? You have to pay for telecom services. You don't have a choice. You can't get away from this. This company's not going anywhere, but Telus is currently yielding 8.2%, and now this year has magically started outpacing the markets for some reason. It's just popped off. And man, what a low we've been experiencing, right? There's a lot of insider buying going on. Let's see what analysts are expecting here. Analysts, have this at $23 and it's currently at $20. Not a whole lot of strong buys going on, but still strong nonetheless. And let's do a quick comparable to Waste Connections. Well, how do people feel about these stocks? Pretty moderate. The company's fairly valued. Analyst on Hydro One, fairly valued. And something tells me with Canadian National Railway, this is going to be one of the only ones that's trading at a massive discount to analyst expectations, right? But if we're looking for income and yield, man, Telus, I don't know how, like I said, we sold it out of the wife's account to put it in VDY. You do get that exposure through VDY, but with the current yield, this might be one worth gambling on this year and just picking the dip up, because it's still well below where we still sold it from. And it was a really small percentage weighting. But I'm looking at it. They've been beating a lot of the analyst returns on their earnings So time will tell what I feel with this, and you'll have to subscribe to see what I end up doing. And if you want to join my chat groups, talk with me about these stocks in real time, you can go at kylelivingston.com, link in the description below as well. But I will pass that question off to you. I'd love to know what you're doing in your portfolio and how you feel. Do you think tech's overvalued? Do you think we're going to see continued high runs this year with some of the AI plays? Do you think this is the year for dividends? I'd love to know about all of it in that comment section below.